financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
So I want to jump in and hit something about this big, beautiful bill that's out here. I want to hit something about SALT deduction. I want to hit something about your personal wallet and the taxes that we pay. In wealth management, everything that we do is basically reactionary, right? Because we react to a tax law, we react to a market condition, we react. And what we don't want to do is we don't want to be reactive, we want to be proactive, okay? So one of the things that I'm seeing right now is people are not really understanding the impact of the 2017 potential sunset. There's this big, beautiful bill, which there's opportunities for it not to happen. There's conversations around SALT deduction. And I wanted to just frame this in a very quick manner, because if we understand currently where we are and where we could potentially be if the sunset occurs. Now, in 2017, the Tax Cuts and Job Act of 2017 is automatically going to sunset at the end of the calendar year. What does that mean? It goes from the current tax bracket, which the top marginal bracket is 37%, and there's qualified business income deduction 199A. There's a whole series of deductions that are occurring that will sunset and go back to the 2016 tax law. Prior to, it was the old tax law, which is a 39.6% bracket. And the SALT, state and local tax deduction, gets restored. And I live in a state that has very high property taxes and very high income tax. And that is a belief that if I'm have this higher SALT deduction, that I'm going to pay less taxes. And what I'm going to show you today is I'm going to show you some proof, which you may or may not agree with, but it is some sort of relative proof, which when I say proof, we're simulating a tax environment for a W-2, and we're simulating a tax environment for an S-Corp, okay? And there's two very different outcomes that are going to happen. Most people believe that if the SALT deduction was restored, that I'm going to pay less taxes. And we're going to show you on the screen. If you're watching this, you're seeing it. If you're listening to it on a podcast, go to the YouTube channel, because the video is there, and on Spotify, the video is there also, okay? So when you look at this, what we've done is we've created an environment where, little disclaimer here, everything I'm about to say is potentially not accurate for you. Your own circumstances will dictate whether or not this is appropriate. This is just a version and a view of very simplistic income components, right? So what I have here is a W-2 person, meaning I work for somebody and I get paid $500,000. It could be a $300,000 salary and a $200,000 bonus. It could be a $500,000 salary. I'm not deferring into a 401k plan. I'm not doing anything else. All I'm basically saying is I make $500,000. I've got a little bit of taxable interest. I got money in the bank. I have a deduction, which there's a mortgage here, and the $10,000 SALT. I am not using the standard deduction. I'm just using an itemized deduction, and I'm going to show you the detail on this. But the tax for 2025 is going to be $103,000 on $500,000 federally. We're not including New Jersey. We're not doing anything here, okay? When I look at this, this is your Schedule A on your tax return, and you're going to see that this person making $500,000 pays about $25,000, about 5% to New Jersey. and they pay $13,000 in real estate taxes, and everybody that's listening to this lives in New Jersey is like, where's that? I want that. Okay. So your number might be significantly higher. So when you look at this, it totals $38,000, but the SALT limitation of 10, which you're talking about, can we get it to 40? Can we get it to these other places? And then there's caps on it. And the reason why I'm using $500,000 is at $500,000, they're talking about that cap is going to be back to 10,000. Okay. But this is what makes people angry. And this is why people are fleeing these states. And it's not true. Okay. Is that I'm only getting $10,000 worth of that SALT deduction on $38,000. So I'm losing $28,000 of deduction. Then I have mortgage interest of $25,000. So there's the 10 plus that, which gives me $35,000 of deduction for the $103,000 of tax. Fast forward to 2026. And what you're going to see is the deduction. Now you get the full $38,000 and you get the $25,000 worth of interest. So your itemized deduction here on line 12 of your tax return is $60,000, $613,000. I must be paying less taxes now. And my wife says I have a resting bitch face when I'm on these podcasts, right? So I'm trying to be happy on this, right? But I am so happy that we can talk about this, but I want people to get this, right? So if I come off with the RBF, all right, I'm sorry. But the reality is I'm paying $60,000 in real estate taxes, New Jersey taxes, and mortgage interest, and now I get that deduction. But your CPA calls you and says, the $100,000 you paid in for taxes, not good. You owe another $20,000 in taxes. And you're like, what? I'm like, yeah, because the tax law sunsetted and we're back to this original thing. We're going to pay $20,000 more in taxes with the law sunsets. So that's really, really powerful, right? When I look at this, this is a summary that shows the year one here in 2025, $500,000 with a $35,000 deduction, and you're at the $103,000. Go to the following year. Now I've got the $60,613, but my taxes totally went from 103 to 123,000. That's a problem. What is that going to do to your budget? What is that going to do to your household savings rate? What's the opportunity cost of an extra $20,000 in taxes being spent? $20,000 a year for the next 20 years, that's the difference of a good retirement plan versus not. Think of the macro impact. That's student debt for your kids. That is, who knows what your ripple is, right? That's why this podcast is designed to get you to think strategically. Now, we're going to fast forward and we're going to get a deduction for something. Okay. Now, I want you to, the big, beautiful bill, okay, affects the W-2 person as bad as it affects the S-Corp person. And I think it affects the S-Corp person substantially more. So what I did here is I said, we have a smart business owner and he makes $300,000 salary. He pays himself a $300,000 or herself a $300,000 salary. And they have an S corporation distribution of $600,000. So they're making $903,000 in this example. And they're getting the same $35,000 of deduction. That's the state and local income tax. So they're paying $200,000 in taxes. But if you look at line 13, take at your personal tax return right now, if you have a qualified business income deduction, and there are limitations and caps on this, you potentially have a $120,000 199A deduction. And if you're really smart, and I can't tell you how many people are missing this, is if you live in New Jersey and about, I think it's 18 or 20 other states, there's a thing called a pass-through entity tax, PTE. New Jersey, it's called the bait tax, which allows the business owner to pay their state level taxes from the corporation and take a full deduction from it from a federal perspective. I am not doing that in this picture, but I cannot tell you how many people miss that deduction. And to me, that is frightening. Okay. So when I look at this, I've got I got my $35,000 worth of deduction. I got $120,000 worth of qualified business income deduction, or 199A, and I pay $200,000 in federal taxes. But I'm angry because I paid $80,000 to New Jersey. Now, if I use the pass-through entity tax of the $80K, I reduce my $600,000 of S Corp to $520,000. So technically, I'm even saving more taxes. But I just want to make it simple. But as we know, my dad and I were partners for 25 years. And Ed, you probably are going to remember this also. He had a sign in his office on the whiteboard. Complex problems have simple, easy to understand answers. So freaking not so true, right? Like, no, complex problems have simple, easy, understand, and complex problems have simple to understand wrong answers. There was something to that. Now I've totally lost it. I had it last night at 3 a.m. when I was thinking about it, right? But the idea is complex problems do not have simple and easy to understand solutions. You might have to go a couple layers deep on it to really understand, am I really paying the right amount of taxes? But if I don't understand the current tax law, how am I going to be ready for the big, beautiful bill? Like, let's get real here. So I got $73,000 worth of deduction that I'm pissed off about that I don't get. And I still got my 25, so I got $35,000 worth of deduction. So that's the $200,000 of federal tax. So now I go to 2026. Same 300,000, same 600,000 in S Corp distribution. My deduction is now 83,000. I'm so happy, but line 13 is gone. There's no qualified business income deduction. My taxes are now $259,000. That is $60,000 of additional taxes. What is the ripple effect in a business owner's strategy when they pay $60,000 more taxes? I believe in macroeconomics, the velocity money and the money multiplier effect. Money in motion, money in the economy makes the economy healthy. When money is put off and it's hoarded, or it is stored, or is given to somebody that doesn't put it in motion, the economy is not healthy. And I'm going to say that paying taxes above and beyond what I want to pay, beyond what I have to pay, represents an opportunity cost. And therefore, the economy, my guesstimate is that if the W-2 payer pays $20,000 more in taxes, that's $20,000 that's not getting spent in their community. It's $60,000 that's not getting spent in the community for the business owner, or invested or saved or whatever it is. But when you look at this, you get back to this and you see the deduction goes up by $50,000. The qualified deduction goes from 35 to 83. The qualified business income deduction goes from $120 to $0. $60,000 more taxes. So why am I talking about this today, right? My position is the House and the Senate are going to vote on a big, beautiful bill. There's going to be an outcome. If you haven't mastered the current strategy with your current plan, what makes you think you're going to do the next one, right? And I really want you to maximize this, because if you get what I was talking about on opportunity cost, what you're going to realize is that every dollar that I waste that is unnecessarily paid represents money lost in my future. Meaning, if I pay an extra $40,000 in taxes, not only have I lost the 40, but I've lost the potential of what that 40 could be worth in my future. And if I do that over and over and over and over again for the next 25 years, the amount of wealth lost is, you can't recover it. All right. So what I urge you to do is, if this podcast resonates with you, okay, this message resonates with you, one thing is you call us at 1-800-797-1000 and you set up a free, no obligation wealth curve conversation. If you like that and you want to work with us, we'll work with you. if you want to just share this with 48,000 friends, we also appreciate that too, because the more people that hear this message, and you can look at your own personal plan and realize, oh my God, I haven't maximized this. What else am I missing? We want to share this knowledge, okay? I've been doing this for 35 years, happily, despite my resting bitch face, okay? But the reality is that what makes me happy is when people get it optimized. When people are not optimized, they're not creating as much wealth as they could. And everything in your plan is a lever. When we move 3 and 4 and 5 levers, you get an exponential potential out of that plan. Look forward to hearing from you. Look forward to talking to you. Thank you for your time.